Welcome to Chapter 2 of Accounting 3370. In this chapter, we'll be examining the policy standards for a good tax. Now that's the title that the textbook authors assigned the chapter. And good seems a little bit oxymoronic because nobody actually likes taxes, but people generally enjoy the benefits that taxes bring. Benefits like well-maintained roads and like an educated society. In fact, Oliver Wendell Holmes, the American author, wrote, "I like to pay taxes. With them, I buy civilization." So in this part of the discussion, we're going to look at the first three standards on which United States federal tax policy is based: sufficiency, convenience, and efficiency. The fourth standard, fairness, deserves a discussion all of its own, so it will be covered in a separate video. So tax policy refers to a government's attitude, objectives, and actions with respect to its tax system. A government's tax policy should reflect the normative standards it deems most important. In the United States, our tax policy is based on 4 standards. The first of which is sufficiency, meaning does it pay the bills? The second, convenience, deals with the ease with which the tax can be paid and the tax structure can be enforced. The third, efficiency, refers to the behavior action of taxes. Does it drive behavior in a good way or in a neutral way? And finally, fairness. Does everybody pay their fair share? We'll get to this fourth standard in a separate video. The first standard for taxation in the United States is sufficiency, which means that the tax should fully cover the government's programmatic and operational needs. If you know anything about United States civics, you know that the federal government of the United States runs a massive deficit between the programs and services it provides and the revenue that it raises through taxes. When you run a deficit as a government, you have 2 options. First, you can borrow money from outside sources, which is the option that our federal government takes, as well as state and local governments. You can also change the tax code to enforce taxes on new tax sources, or to change the taxable base, or the tax rate. Creating a new tax source is controversial because nobody wants to be taxed on something more than they're already taxed on. But this may be a new way to create revenues. For example, revenues from Indian casinos and gambling, lottery taxes, or in states that have legalized the use of cannabis, this tax on the medical use and sales. A change in tax revenue can also be driven by a change in the tax base or a change in tax rates. For example, the Social Security portion of the payroll tax that comes out of each of our paychecks has remained the same percent over time. However, the amount of your salary that's subjected to that tax has increased over time, meaning that more of your revenue is taxed, which generates more tax for the government. And a new tax rate means an increase or a decrease to try to drive behavior. When deciding whether the government should change the tax structure, the government can forecast in 2 ways. A static forecast assumes that the taxpayer behavior or the tax base is not going to change as a result in the change of a tax rate or the identification of a new tax source. A dynamic forecast assumes that tax rates and taxpayer behavior, or the tax base, are correlated. As a result of a change in tax base, consumer behavior is also going to change. And let's take a look at some examples of that. We talked in Chapter 1 about my dream car, the Corvette. Corvettes are manufactured in Bowling Green, Kentucky. Now let's pretend that the city of Bowling Green, to create new tax revenues, decides to create a tax on each car that gets produced within their city limits. This tax is equal to 0.75% of the value of the invoice price of the Corvette. We'll assume that the plant produced about 9,000 Corvettes and that the average invoice price of these vehicles is around $55,000. So if the Corvette production remains constant, that is, the Kentucky plant produces the same number of Corvettes as it did in 2018, the tax would be calculated as such. The tax base would be the $55,000 worth of Corvettes times the 9,000 Corvettes produced, or a total of $495 million. The tax rate is 0.75%. And the tax revenue, if GM kept their Corvette production constant, the revenue would then be $3,712,000 and a half. But this assumes that the GM plant doesn't retaliate and move production of the Corvettes somewhere else. Let's look what happens if that were to occur. Our tax base, in this case, our tax base would decrease from $495 million to $412,500,000, even though our tax rate would be constant in both scenarios. As a result, our tax revenue decreases from $3.7 million to $3,093,000. This is a pretty significant decrease, especially for a presumably small municipality that presumably relies heavily on the tax revenues from this Corvette plant. Now let's look at two economic reasons why a dynamic forecast might be more accurate than a static forecast. One of those two economic theories is the income effect, which is the tendency to engage in more income-producing activities once taxes increase. So let's look at an example. When the Congress was considering what to include and what to exclude from the Tax Cuts and Jobs Act of 2017, they had briefly considered taxing the value of tuition waivers, which, as a graduate student, I was receiving. It didn't mean I saw any more money in my paycheck, but it meant that I didn't have to pay tuition. By taxing the value of my tuition to me, my tax rate would have effectively increased from 12% to 22%. So let's look at how that would affect my overall income. Before, and let's assume for simplicity's sake that there are no deductions. We'll be covering the deductions and the credits in subsequent chapters. But for simplicity's sake, let's just look at my base salary. If I had to pay 12% of my base salary, this would mean a tax of $2,730, which would leave me with a disposable income of $20,020. But at the new rate, I would then pay $5,005 in taxes, which would leave me with a disposable income of around $17,500. Now, while this isn't a big increase, it's going to feel like a big increase because my disposable income is pretty low already. So this means that I'm seeing $2,275 less in my annual pay as a result of the rate change than I would otherwise see. To make that up, if I got a job at Starbucks, I would have to make up about $3,000. The $2,275 net of taxes, which I compute by dividing 2,275 by 1 minus the income tax rate. This means that the feds would be getting more taxes from me. They'd be getting around $5,000 from my student job and around $600 from my Starbucks job, which is 22% of that $2,275. The income effect tends to impact people in the lower echelon of the earning cycle. Substitution effect is the tendency to substitute leisure time for working time following an increase in the tax rate. Now let's look at another example of this. Once I got my doctoral degree and got a grown-up job at a university, we were assuming that I made $100,000 per year. Now let's say the federal government increased the tax rate from 22% to 28%. Before the increase in tax, I had planned on teaching 2 additional classes, which would add an extra $30,000 to my salary. But because that $130,000 is going to be taxed more heavily, I decide not to, and instead, I decide to rely on my $100,000 salary alone. So let's look at what that would mean for the collection of taxes. Before, I was paying, assuming no deductions, again, for simplicity's sake, I was paying 22% of my $130,000 salary to the federal government, which meant the feds got $28,600 in revenue and meant that I had around $100,000 worth of revenue to play with. After, I decide not to work over the summer. I pay 28% of my taxes to the feds and have a disposable income of around $72,000. This means the feds are getting less taxes out of me because I chose to work less. I chose to accept a lower disposable income in exchange for more leisure time and slightly less taxes. The substitution effect tends to impact taxpayers in the upper echelons of the income scale because they have more money to play with. The second policy standard for a good tax in the United States is convenience, meaning a tax should be easy to collect and easy to administer. The collection piece addresses us, the taxpayers. We should understand how we are being taxed, and the taxation process should not be intrusive. For example, the state sales tax is just an add-on to everything that we buy. We don't even think about it. Likewise, the federal payroll taxes and the federal income tax withholding comes out of our paycheck before we ever see it. So that way, we don't have to deal with mailing the federal government a quarterly estimate of what we owe, unless we're self-employed. And we'll get to that in the second module when we talk about individual taxation. A tax should also be easy to administer, and the IRS operates very efficiently compared to the volume of tax dollars that they collect. The efficiency standard for tax policy means that a tax should drive behavior. Now, the way that a tax should drive behavior is unclear. Under the classical economist view, tax should not cause an individual to act any differently when they're being taxed than when they're not being taxed. A tax should have a neutral effect. That is, a taxpayer should go ahead and do everything they would normally do, regardless of their tax status. Under the fiscal policy view, taxation should motivate a change in individual behavior. For instance, So how do taxes modify behavior? One way that the tax code is designed to modify behavior is to incentivize taxpayers to reduce negative externalities or the undesired effects of corporate development. An example of that is the subsidization of recycling. By providing a tax incentive for creating a recycling program and a clean energy program, the Green Building Program, it encourages corporations and cities and states to offer recycling services, a cost that they would not be willing to take, potentially, if it weren't subsidized. Likewise, there are a number of clean energy subsidies to promote development of new energy sources with tax breaks, rather than energy sources that have a higher tendency to pollute. Another way that taxes modify behavior is through the inclusion of tax preferences. For example, the mortgage interest on the purchase of a home is tax deductible, encouraging people to buy a home. Contributions to charities are tax deductible if you itemize your deduction. This means that a person can reduce their tax obligation by donating to a recognized tax-exempt organization. This means that the government is willing to accept lower taxes in exchange for the funding that we, the taxpayers, provide to these nonprofit organizations. Every year, the federal government provides the tax expenditures budget, which is an annual publication that describes and quantifies exactly how much tax revenue is lost because of these tax preferences. The example we worked through earlier about the income effect, if the government had decided to tax my tuition subsidy, likely shows up in that report. To sum up, in this chapter, we looked at the 3 of the 4 policy standards for taxation in the United States: sufficiency, convenience, and efficiency. And in the next unit, we're going to look at the 4th policy standard, the standard of fairness.